With over 18 months of lockdowns and restrictions, and many people looking for ways to make their money work harder, it's not surprising to learn that inflows into the stock market have increased like a rocket ship to Mars, and with it, asset prices. Since 2019, average daily trading volumes have increased from $7 billion a day to more than $14 billion, and that number is still climbing. Today, we're going to pitch small cap against large cap to see which performed better. You might be surprised by this one. So, in 2020, despite continued fears of a market crash, COVID, lockdowns, and reduced capacity in terms of economic growth and GDP, the US, the NASDAQ specifically, grew by 44%. Now, if you were following the news throughout 2020, you may not feel as though the NASDAQ grew by 44%, but it is actually true. And if you are invested right now, you're probably looking at your investment portfolio, pleased that your investment portfolio is up. And we shouldn't complain about that. It's always good news when you're in the green. It's bad news when you're in the red. You have to learn how to stomach it. But if you've been following my channel for a long time now and you're a first-time investor, you're relatively inexperienced, you want to build your portfolio, and especially if you're looking to build your portfolio using individual stocks where you're buying specific companies that you are choosing, I often harp on about the fact that you should first and foremost start with large cap companies. And there is a reason for that. With large cap companies, these are big companies that are global, they have a loyal customer base, they make a lot of money, they sell a lot of product, they're probably making profit, they may be actually sharing that profit via dividends, they may be a dividend aristocrat. And with these companies, because of their size and their scale and their history, you're likely going to experience less volatility than if you went with a small cap company. So what I want to do in this video is talk about some of the historic performance when it looks at small cap versus large cap companies. And this will be great if you're at that point where you're slightly more experienced now and you actually want to dabble into small cap companies. We're going to have a look at some past performance, have a look at some most recent performance right now. And at the end of this video, I'm going to give you a handful of ETFs that you can use to access small cap businesses in the US and in the UK. So stick around to the end of the video. If you're not subscribed already, consider doing so. Also help me smash the like button for the YouTube algorithm. And if you have any questions or anything that you would like me to expand on, maybe in another video, make sure you leave that down as a comment below. Now, let's start off by talking about how companies are classed, or what it takes for a company to be classed as large cap, mid cap, small cap. There's a couple of other categories underneath that, nano and micro. So this right here is just a visual kind of like representation of how they are classed or categorized according to their market capitalization. For a small cap company, they have to be valued between $300 million and $2 billion, which is still a lot of money, but we are in an age right now where Apple is worth over $1 trillion. So in relation and in comparison to that, these guys are still relatively small. Now, with a small cap company, they are the opposite to large cap. I'd spoken about the fact that they are large. They probably have a big customer base. They probably have a lot of financial strength, maybe paying dividends, so on and so forth. What you're finding with small cap companies is they are going to be the opposite to that. They may be relatively new businesses, still finding their feet. Their stock and their share price may be slightly more volatile because they are going to be impacted by economic slowdowns, but they could also be impacted in a positive manner by economic increases in speed or productivity, so on and so forth. Prime example here is COVID. Off the back of COVID, these stocks have done very, very well indeed, and we'll see some of that in the numbers shortly. What I'm trying to say here is with small cap companies, you have potential for greater reward, but you also carry higher risk. If you've taken my course, you will understand the difference between trying to manage your risk and trying to ensure that when you build your portfolio, you're able to do so by having exposure to different areas, asset classes, and parts of the market. Small cap, mid cap, large cap as well. So with small cap companies, more volatile, but potentially better reward. But let's have a look at some of the past performance when we start to compare small cap and large cap. So this right here is something that I pulled off the internet. I will leave a link in the comments below if you want to find the source data for this. But this looks at small cap versus large cap from the year 1979, which is the year of my birth, all the way up until 2012. Now, the highlighted columns here are where the large cap have underperformed the small cap sector. And if you count the numbers here, it basically tells the story that large cap underperformed small cap sectors or companies 20 times within that period of time, meaning that small cap outperformed large cap 20 times between 1979 and 2012. Pretty impressive numbers. And when you start to look at them, you start to see that the outperformance numbers are actually very impressive as well. Now, let's fast forward to what we're seeing currently. And it's interesting because I was having a conversation with one of my contacts still in the industry, and he was talking about one of the big investment houses. And one of the big investment houses is taking a particular interest in the small cap sector right now. That's where they feel that there's going to be a lot of growth. And this graph right here kind of tells the story of that. So what we're seeing here is the increase or growth that we've seen in the small cap over the last year. We can break this down into numbers a little bit more. And what we can see here is that the small cap sector has performed at 52.05% in the US, but the global small cap sector has performed at 46.69%. That's pretty incredible in terms of growth in one part of our markets, which kind of explains why a big investment house is looking specifically at the small cap sector as a potential opportunity as we start to turn out of COVID right now. If we look at these numbers more domestically, bring it back to the UK, this one is actually pulled out of Hargreaves Lansdown. And what you can see in this chart is when you go back to September 2020 again, you'll see that the small cap was around just over 5,000, maybe about 5,100, compared to where it is currently at just over 7,000, I think about 600. So there's almost a 2,500 point swing there. Huge sector for growth. And this begs the question that if you are investing right now, are you sufficiently diversified within your portfolio in order to be able to take advantage of small cap exposure so you can get some additional growth within your portfolio? Now, if you are buying individual stocks, this may be a little bit more tricky because you have to do the research in all of the companies that sit within the small sector and then whittle down the ones that you feel are the best. You may decide to get a list of all of the companies that are in that sector and maybe have a look at the top 15 and 20 first, and then start to whittle down, make a selection from there. And if you want to, you can go further and start looking at some of the companies that are lower down on the list, looking for very specific things. But if you're going to do this research, you would need to at least understand what you're looking for in the companies that you want to buy. It will take time. If you don't have time, this will lead to the next point that I want to make, which for many people should be something you consider. Yes, we've been in lockdown. Trading 212, free trade have become overly popular now because of zero commission investing and trading. However, if you don't have the time to do the research, pick an individual stocks, and you really should take the time to do this, then this alternative may be the better way. Now, again, if you follow me for a while, I talk about my investment strategy, which is a core satellite approach. Most of my money is invested in index funds and ETFs. If you are using index funds or ETFs and you are invested in something like maybe the Vanguard V3AM, that is a global all cap ETF, or maybe the FTSE Global All Cap within Vanguard, you are going to get access to, or you would have had access to, small cap in the United States, small cap here in the UK, so you would have benefited from that. And that is a clear advantage, distinct advantage to not trying to do it yourself, but trusting professionals like Vanguard or Money Farm or Wealthify to actually do that research and package the portfolios for you on your behalf with a view of capturing of global diversification across all of the sectors. Now, if you're not invested in the V3AM, don't take this as financial advice and you're interested in the small cap, well, you would have been invested in that. So maybe that's something worthwhile researching after you've watched this video. The same thing applies for the FTSE Global All Cap as well. Maybe it's something that you want to go and research specifically with Vanguard. But what I'm trying to say here is I invest in a core satellite approach that would have given me exposure to small cap within my overall investment propositions. I still have individual stocks that I hold around the periphery, but I believe, even with my experience, that I would rather source this out to somebody else to do on my behalf. Now, if you are watching this and you're just thinking, right, Pete, tell me how I can access some of these small cap companies, we're going to get to that right now. So if you wanted to access the small caps, I've got 3 ETFs for you, which you can access. I'm going to give you 2 for the US. I'm going to give you 1 for the UK. So if you recall my video about Invest Engine, if you haven't watched that, this is going to be the thumbnail for it right here. Go and watch it. They are giving away £50 for you to actually try the platform. There are some rules around it, but I explain it in the video. You will recognize this first ETF because it's one of the ETFs that I selected in my portfolio as I was demoing Invest Engine in that video. It is the SPDR Russell 2000. That will give you access to the small cap in the United States. The next one is the Invesco S&P Small Cap 600 UCITS. That one is actually a very low cost ETF at 0.14%. In the UK, the one that I have found is the iShares MSCI UK Small Cap ETF, which is a little more expensive. It's called the CUKS. It's 0.58%. You can get that within Hargreaves Lansdown. Those are 3 that are there for you. But I thought I would share this with you because when you start to look at building an investment portfolio, and you've been doing this for a while and you're gaining confidence, it's really important to understand where your growth is going to come from. Professional investment houses will sit there with their investment committees and have a look at the market and decide where they want to allocate their money. Yes, it is arduous. Yes, they have teams that do it on their behalf. It's one of the reasons why I choose to pay extra fees for them to look after my investments for me, because I don't have time to do it. But if you are of the train of thought that you want to manage it yourself, then it is really important to take some time to really understand how the markets work and strategically look at your portfolio for how you can better position as and when you need to. That doesn't mean you've got to start moving your portfolio around every single month. Absolutely not. But when you're reviewing your portfolio, which you should do at least once a year, these are some of the factors that you should be looking at. But hopefully, when you started to invest, what you have been doing is putting at the center your goal and investing accordingly. And hopefully, you've had a conversation and you understand where you sit on the risk profile. The risk profile is really, really important. I speak about this in my investment course. I talk about investment term as well. Those two things go hand in hand, your risk profile and your investment term. One impacts the other. In other words, if you're looking to invest for a long time, you should not, you can afford to take more risk. But if you're only investing for 3 years, which is really, 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 really short, you probably shouldn't be investing in the market anyway. 5 years, you need to be taking less risk. These are all fundamental things that you have to understand if you're looking to get started in investing, starting to build your investment portfolio, and things that you have to review as well. But guys, I hope you found this useful. Let me know what you think in the comments box below. As always, I appreciate you for watching. This Sunday, we have Gary Stevens on the channel, 8 p.m. He's going to be answering questions. He is a millionaire ex-trader, most profitable trader in 2011 with Citibank. I would love to see you there. If you've not listened to the podcast already, there it is. Catch you on Sunday.